And checking international markets, the markets in Europe have ended the week lower. London's FTSE 100 down 29 points with heavier falls on the DAX and Euro stocks. America's markets were also in the red, with the Dow Jones closing 46 points down. The S&P 500 and the Nasdaq also ended the week in negative territory.
For more on the markets, we're joined now by Jeremy Hook, Investment Director from TMS Capital. Thank you for coming in this morning. The RBA's quarterly statement this week, pretty upbeat about the situation and pretty comfortable with where the cash rate is.
Yeah, that's right. There was a lot to digest, as there always is when the RBA gives its statement. There were some interesting things, some things that weren't entirely expected. They gave quite a big review of the China share market volatility, which was really quite interesting, and the backgrounding to it. They seemed comfortable with it, which is important. That's had a real impact here. They talked a lot about the Australian dollar again and see it going lower. And one of the interesting consequences of that happening as it moves into the 60s, as they see it, is how it'll impact here on local inflation. As people buy more foreign goods with the lower currency, they actually expect inflation now to go up next year, which is something different in the settings, but not enough to make the cash rate move. So that should be stable for some time. But generally speaking too, they did give a slightly subdued growth outlook. And one of the reasons offered was unusual and I think unexpected, was a little less immigration. And they see the current population growth rate of about 1.4% declining a little bit, and that having productivity and growth consequences. Although they may not be enormous, it's going to be something to note.
Did that feed into the RBA's comments on unemployment, saying that it's possibly past its peak?
Yeah, that is, because there'll be fewer people participating in the workforce as a result. And generally speaking, they're relatively happy that the mining boom ending, coming at a time when there is an East Coast construction boom of sorts happening, has actually done quite dovetailed very nicely. Not perfectly, but relatively well. And it was a very encouraging part to see that maybe an expected rise in that unemployment rate really won't be happening in the way that people were thinking a few months ago.
Because unemployment did track up slightly higher than we were expected at 6.3% now, but
yeah,
part of that is to do with increased participation rate as well, isn't it?
That's right, that's right. As people work longer and more people enter the workforce, younger, more females, etc., these are things that impact on that participation rate and therefore the unemployment rate. But realistically, if that's the peak in the cycle for unemployment, we've dodged a bullet over 10, 15, almost 20 years, so it's really a very benign outcome given the big stimulus the mining boom provided in terms of work, and if that's the hangover, it's really very mild.
Also on the plunging Aussie dollar, warnings about the US Federal Reserve lifting rates there and the impact that'll have here.
Yeah, I thought that was a really significant thing, and a few market commentators were onto it this week. Everybody knows that rates are going to go up in the US, and the thinking is it'll be next month in September. But it's surprising when markets still know everything, that the reaction when it actually materialises is still quite profound. And so the RBA was warning market participants about expected volatility when that first rate rise happens in the US. They did make the comment that with even a couple of rises in US rates, monetary policy there will be very accommodative. It'll actually encourage growth still. So it's hardly a warning of any direness, but it does still say, be prepared. And this is the case. We saw that in May as well, when the markets almost shifted from a view that rates will go up. They got very concerned and volatility rose, big sell-offs in bond markets, equity markets, and that has impact. So we will have to expect that as we come into the end of the year.
Now, the Australian share market took a huge dive yesterday, in particular the big four banks, and it was a day where we also saw ANZ trying to do its capital raising. It wasn't a great series of events there, really, was it?
No, and it really impacted on the whole bank sector, both on Thursday and Friday. So before trade on Thursday, ANZ went into a trading halt. They said we're undertaking a capital raising. Again, just like my previous comments about US interest rates, no surprise in that. We've known that all the banks have been required to increase their capital, their Tier 1 capital ratios, just to make them safer, more or less. And that's been the APRA, the regulators' dictum there. And they've got to do that by next year, the end of June next year. they've undertaken, most banks, to start to do that a bit early. NAB did it 3 months ago, and it was ANZ's turn to step up to the plate and fix up their capital this week. So they raised $2.5 billion through an institutional placement at a discount to the market price of about 3.5%. And they're offering all shareholders in ANZ a share purchase plan so they can buy in as well. That will certainly help their capital ratios, but it took money from other banks, so the other banks sold off as investors positioned themselves to need to fund this. It does change the earnings forecasts for the banks, and it will slow down their return on equity as well. None of these are really bad things, but they're just things you have to bring into account. But the next phase for everybody is looking at Wednesday's Commonwealth Bank report, and the expectation is they're going to announce a large rights issue to do the same kind of thing, and that again will have an impact.
Well, we will have to wait and see, won't we? Jeremy Hook from TMS. Thank you so
Jeremy.
much for your time this morning.
Thank you.